Good afternoon and good evening, and welcome to Traders Workshop. Today is Thursday, August 23rd, and I'm really excited to have my next guest on Traders Workshop. Traders Workshop, where we bring in the experts from the NinjaTrader ecosystem to talk about their experience and talk about the markets with them. Real quick, before we start, I would like to remind everybody that futures and options trading contains substantial risk, not for every trader. You could potentially lose all or even more than all of your initial investment. So that's why we recommend you use risk capital. What is risk capital? It's money that you can afford to lose. It doesn't keep you up at night, and it doesn't extend your retirement horizon. I do want to remind everybody that past performance is not indicative of future results, and that what we talk about today in this show shouldn't be taken as trading advice nor financial investment recommendation, but should be used for educational purposes only. And with that, it is my great pleasure and my total excitement to have one of the greats, Larry Williams, on Traders Workshop. Larry, how you doing?
Hey, great, Tom. Thanks very much for having me here. I've been looking forward to this. It's always such a pleasure to be able to have your name in public places talking about what I love. So I'm excited about this.
That's great. Yeah, we're excited to have you here. And just so we level set, where are you calling in from, Larry?
Red Lodge, Montana.
Okay, and is that where you stay for the summer? Is that
that's definitely
where you
a summer place? Yeah, winter is pretty vicious up here in Montana. I grew up here, not far from Red Lodge, but we spent the summers here, and delightful. Good fishing, beautiful, clean air that's never been breathed before, and a lot of friends, of course, from the past. So we enjoyed it a lot.
Sounds incredible. Just want to ask people who might not know you. We do have a lot of new traders that come to our live streams. Can you just tell me a little bit about your background and how you got started in the trading business?
Sure. It really began for me in 1962. I was in college, and the stock market crashed. President Kennedy rolled back steel prices, and the market crashed. And I didn't come from a family that ever owned stocks. My dad worked in an oil refinery, as I did in college. And I said, well, what does that mean? And somebody said, well, if you would have bought this stock yesterday, it went down a point or it went up a point, you would have made $100. And $100 back in 1962 was like about $1,000 now. And I said, this is for me. You just guess, and you can make money. You don't have to work in an oil refinery. You don't have to work on a farm or a ranch. Like, how do I do this? And I've been trying to figure it out since 1962. So it's 60 years now of looking at charts.
And so did you go to school in Montana? Is that where you went to school?
I first played football at BYU and left there after my freshman year. Graduated eventually from the University of Oregon, a lot better football team, with a degree in journalism and a minor in psychology.
Right. So I was going to ask, if you're in Montana or in 1962, certainly the trading landscape was a lot different than today, right? You didn't have the access to all the information then. So you discovered where to go for that.
Well, the Wall Street Journal came about 3 days late back then, maybe 4 days. The time frames have changed so much because now it's instantaneous. I know exactly how many stocks are advanced and declining right now, thanks to NinjaTrader. I know exactly what's going on. Back then, it was much slower. So your reactionary time back then could be very slow. Now your reactive time is quite a bit quicker.
Great. So I think, I know a lot of people are here they're here to hear you talk about the markets and your experience, but also, how you use your indicators, what you've developed to interpret the markets, especially in a year like this year. I mean, we talk about this on our shows. Have you seen a lot of anomalies or differences, or is it just another trading year for you?
It's another trading year. We got a buy signal, literally the week of the low, the same indicator that a guy gave a buy signal, the week of the low in 2020. That's a COVID panic low. So to me, this is not an anomaly. It's the markets. Like what markets do. A lot of irrational activity. A lot of it we can't understand, can't figure out. Some we can. And this year, I think has been pretty much our expectation. Down early in the year, big, strong rally coming, starting, it's already begun, pull back in here, then we move up higher.
Great, great. So real quick, Larry, I do want to switch over. You had very graciously prepared some slides to help our viewers understand your thinking and your views on the market. Can we just jump right in? Is that all right?
Absolutely. Let's do it. Let's go for it.
Right. So just an intro slide, Larry Williams. If you want to just expound,
this
feel
is
free
really
to talk.
interesting. I think so many people have way too many indicators in their charts, and they're all redundant. If you look at my percent R, Bollinger percent B, Jerry Appel's MACD, Richard Dyson's stochastic, they're all the same. There's not an ounce of bit of difference between any of them. And so indicators are terribly, terribly redundant. So I think you have to break out of that. People just put indicators on the charts because they can. They're in the software. You'd be really careful of that. I think you have to say, what's the purpose of this indicator? Why is it there? And then each indicator serves a specific purpose, and that's going to help you in your journey of trying to trade or understand the markets. So what can indicators do? This is my thinking. An indicator can show overbought, oversold. One can show momentum. One can identify the trend for you or when the trend is changing. Inform money, I'm real clear after 6 years of doing this, there's smart money in the marketplace. And we can figure out when they're buying. We got a pretty good idea when they're buying or selling. So that's a tremendous indicator to help us understand what most likely will happen in the future. And then cycles. I really believe in cycles. I think that the markets are cyclical, that things are, I don't know if they're quite predestined, Tom, but there's a cadence to how things happen. So I definitely pay a lot of attention to cycles. We're going to look at those right now in a little bit at the 10-minute bar chart. If you would love to see that, we can get a glimpse of the future. Price patterns. There's certain patterns, not the heads and shoulders and type of stuff, but there are patterns that I like to see in the market that suggest what may happen. And then value. I think that basically markets move from here to here because of fundamentals, valuation, fundamentals. They go like this because of emotions. That's where technical stuff comes in here. But from point A to point B, that's fundamental. Markets are fundamentally driven. That's why they exist. And you have to look at both the fundamental aspect and the technical or the emotional aspect of trading.
So Larry, there's a lot you just said, and with the redundancy that in my experience, I've seen traders have redundant indicators, like you said with the momentum indicators, but this is a different thing. This is trying to maybe complement these indicators, could complement each other rather than being the redundancy that you mentioned with MACD and stochastics, et cetera.
Yeah, clearly. I mean, all those indicators were developed about the same time. Jerry Appel, of course, a dear friend of mine. Dyson, of course, I knew, popularized by a couple of people, but we all developed these ideas in the mid 1960s, some a little bit earlier than that, and we didn't really understand what we were doing. And finally, I realized, no, each indicator, one should show accumulation, one should show overbought, oversold, one could show this, and then you have a packet of indicators that help you understand the market, as opposed to just, oh, here's an overbought, oversold indicator, look at divergence, which doesn't work very well. So to me, I'm a conditional trader. I look for conditions. When these indicators usually come together, that's a condition that will cause an up move or a down move. So I'm not a technical trader, really. I look for conditions, and that's why each indicator needs to be different. Otherwise, they're just redundant.
Thanks for that. That's great. That's great. So I'm just going to move along.
Wow, this is in memory because I think most of these indicators we should get rid of. Mine as well. That we have to be really careful about. People show me their computers or in the old day their charts. Oh my gosh, there's more. Get rid of some of the stuff. Simplify. That's all.
Right. And I get exposed to a lot of that now with after COVID, and we're all remote or we're starting to get in person, but I see it a lot on social media too, when people are becoming more forthcoming with their charts, and you just see, so much on the charts, I turn off. I don't want to read it.
Yeah, and what are they doing? I read today somebody's bearish in the market because the sign indicator's overbought. So whoopee. I mean, I know just an overbought indicator might mean we're going to go higher. So you have to understand the indicators as well. It's not a simplistic thing. That's why if you know, oh, this indicator does this purpose for me, then you can put all this stuff into perspective, the right perspective.
Sure.
Well, this is really important. I think it's best for Ninja people. If you look at the trading championships, and I won one back in 1987, took $10,000 real time, real money to $1.1 million in real trading. And most often these championships are won by my students. My daughter won one in 1997. She took $10,000 to $110,000 real time, real money, real trading. If you look at these championships, they're usually broken down in stocks, Forex, options, and futures. And I looked at the results, which group has the largest percentage gains year in and year out. And it's really interesting because consistently the winner of these championships, the largest gains have come from futures trading. Now you'd think that would be options or Forex because they have the best marginability. They can get the best bang for their buck. And stocks aren't surprising because you can't get a lot of bang for your buck with even using margin there. But to see that the consistent profits, and these have been substantial, 200-300% a year in these trading championships, 600% a year in the trading championships, by and large, it's come from future trading, not trading Forex, options, or stocks. So that tells me that's where I want to focus. That, you know, clearly the lower hanging fruit and this trading business seems to be from futures.
Interesting. Yeah, and you know, we love to hear that, obviously being NinjaTrader focusing on the futures market. Is that a matter of, you know, the amount of leverage you get as well, or is it, you think it's more about the bigger, you know, I could see an argument for futures are generally broader based assets, right? You're not looking at a penny stock or a very specific stock. You're looking at something's more, there might be more information about it. I don't know.
I think there's more reliable data. Forex can get really emotional. Options, same problem, that you could get too much of a bang for your buck, so you get blown out real quickly. And it looks like in terms of the marginability, futures is about right. Plus, we have the commitment trader report. We have crop reports. We have a lot of history in these markets. So I think that they're more manageable. I'm not saying any market's very manageable, but they're more manageable than the others, that we have better data, a better idea of fundamentals in these futures markets than we do the other markets.
Sure. So, you know, let's move along. I think we've gone there.
So, you know, after 15 years of trading championships, we have about that many years of trading championships, now a little bit longer. That's clearly what we're told, is that the money has come from the future traders. They've always had the best performance. Not every year, but like 95% of the years, they've outperformed any of the trading opportunities. So that tells us where we should focus.
Yep.
So to maximize indicators, we need to understand how the market works. And I want to start to explain part of how I have found the market to work. This is just my view, and there's a lot of other views about how the markets work. But this is mine, which is pretty much I'm a mechanical guy, pretty mechanistic guy. So let's look at the next slide, and I'll show you how I think markets move. And this is important to understand how to trade and how indicators work. Clearly, markets go from little ranges to big ranges, a trading range to a trend move, if you will. So that means that if there's a big trend move, I probably don't want to be involved. I want to wait until the market settles down in their small ranges. Then my indicators will work better because I know the market will move up or down. I'm not so certainly direction yet, but I know that I have a trend move coming, which is what I want to get involved in. Most traders see a trend move and get involved just when the trend ends. The other thing that really helps to understand how markets work is that market tops consistently happen with a large close to low. The markets close way off their low. That's how markets top, clearly, any time frame. Weekly, monthly, daily, intraday. The reverse is equally true. Markets bottom closing on their low. So they have a very large high to close. And that's how markets bottom. Now, most people see that and get emotional and start to sell at the bottoms and buy at the tops. So once you understand that, and I think we have some charts, we're going to look at that. Let's go to our next slide, Tom. Well, more of how markets move. We go from congestion to creation, which is really small ranges to large ranges. And this is really interesting. We go small open to close. If you look at your charts, you'll see this. The market will have a small open to close, small open to close. Then a day later, a very large range, large move from the opening to the close. So that's where the money is going to be made. So if I see small net change open to close, I can prepare for a large trend move coming. And we'll look at a next chart now in the U-shape. The market is U-shaped on intraday. Let me show that on the next chart. I think that's where we are, Tom. Yeah, this is the S&P E-minis. And notice at the bottom, I have the volume. And notice how U-shaped that is. There's a lot of volume early in the session. Volume dries up, and there's a lot of volume in the end of the session. Now, if you can do the same chart with the average daily range, and you'll see the same thing, because after all, range is driven by volume. So the markets intraday start big. It's like everybody goes to work in the morning on the freeway. They're all busy. And there's not much traffic on the freeway. Then everybody goes home and there's a lot of traffic on the freeway. The day after day after day, as long as I've been trading, that's how markets actually move intraday, which tells us as traders, oh, I can see opportunities in the morning and I can see opportunities towards the end of the day. The middle of the day, it's just, it's no man's land, not much is going on. So once you understand the markets are U-shaped, it's going to help you as a short-term trader.
And Larry, we talk about that a little bit on our bars closing show, because we call it the volume smile, right? And we look for that smile to be completed. So when we start the show, it's 3:15. You've got about, on a 10-minute chart, you've got about 4 or 5 candles left. And the volume doesn't kick in until those last, 2 or 3 candles. But it really is fun to watch when we try to complement what happened at the beginning of the day with the end of the day volume.
And remember that volume drives range. So the ranges are larger at the end of the day and at the first of the day. And that's where the trading opportunity. We need large ranges. We need volatility as short-term traders. Let's take a look at our next slide, Tom.
Sure.
So the market's U-shaped. That means there's times of opportunity, which is what we were just talking about. And you guys have talked about with your smile. So a day trader, what I've seen with day trading, people think they can make money every day trading, and not every day is the same. So I'm looking for unique days that should have explosive moves to the upside. That's what I want. And I'm going to show you in a little bit how we hold on and how we actually trade those days. So all days are not the same. You have to be very careful to find that opportunity. So do we know market tops often take place with price closing at or near the high of the day or week? This is really important for short-term traders. I'm going to show you in just a moment why. You really need to burn this idea into your mind that if the market starts to rally, it will close close to the high of the day, or in a decline, it's going to close most close to the low of the day, most all of the time. Now, our next slide, I think, might drive this home.
Yeah.
So if we close near the high or the low, and here's an actual example of it, you can see on the very first blue zone up there. Look how the market topped in the F&P. We had 3 days consistently closing right at their highs, and that was a market top. If you look at the market lows and those blue balloons, if you will, the market's closing right on the lows. And that's what I'm looking for to be a buyer, is markets closing on the lows, as opposed to looking like, oh, the market looks real strong. If you look just before this 1st of August, we had a really strong day, close right on the high. The next day is the high of the market before it starts to decline again. So I'm very focused on where markets close during a day. And that means a lot to day traders. Let's go to our next slide. And this is what I think one of the really big takeaways in my life is trading. And then understand, it seems pretty simple, but looking back on it, it took a while to figure this out. Trend is the basis of all profits. No trend, no profits. I mean, we all understand that. You've got to have some type of a trend move. However, what causes trend? What's the function of trend? That was the breakthrough for me. And the secret is what causes or what trend? Well, here it is. It's on our next slide. trend is a function of time. The more time you're in a trade, the more opportunity for a trend. So time is our favor. In fact, time is an ally for us. I want time in a trade. The more time I can get, the larger my trend move, in theory, profits can be. So time is really, really critical to me, even on a very short-term basis. And I think I can show that. I think we have that on the next slide. Let's take a look at that. This is why day trading is so tough, is because, go to our next slide, most of the time the price is in a consolidation. It's wavy about 15% of the time, and it trends about 15% of the time. So we have to catch that 15% of the time. And we don't know when the market is going to trend. We have an idea, but we don't know for sure. So the market can tell us that. And I think that's in our next slide, Tom. This is the day trader's dilemma. By definition, you can't catch large trend moves because you limit it. You have 4 hours, 5 hours to make money. That's it. Whereas a holding position, I'm going to hold overnight, I could have 15, 20, 30 days and catch a really big trend, which means that I can bet small and catch a big move and make a lot of money. Whereas if I bet small and lose, I'm going to lose small. Our next slide, I think, shows the opposite of that.
Right. And just to be clear,
Yeah.
we're talking about past performance. These are ideas that certainly make sense, right? Because we talk about it, Larry, just on our show, the morning show, we have all day. So we talk freely about ideas and we don't limit ourselves in time. At the end of our show, we kind of use the end of the day as our trading day. So our ideas about trading ideas going into the end of the trading day are limited because of that very thing. We don't have time. We put that time restriction on ourselves as part of the show, but a trader can do that too, right? If you're saying I'm not carrying a position, I only have so much time at the end of the day to look for that 15% of the time getting a trend.
Right. And I think most day traders feel like there's a lot of fear of holding overnight. They don't want to hold overnight for whatever reason. Actually, if you do the math on it, you'll see that most market moves occur from the close to the prior opening. The opening to the close is not as much of the trend move, say in the Dow Jones Industrial Average or the S&P 500, as the opening, the night's opening to the following close. So you really have to be careful and understand where the move comes from. But here's the critical point for real short-term traders: these large range days, that's when we get a trend, an intraday trend like you're talking about. They close on their extremes, which means, let's go to our next slide. I think it's going to drive home the point. Look at these large range days in the bond market. The very last one, where did we close? Right on the low. Go back to the little blue dot before that, close on the low. Before that, on the low. So whenever you get a large range day, most often you're going to close on the extreme of the day, which means as a short-term trader, if I get a winning trade on, I want to hold. I don't want to try to dance in and out, catch a little here, a little there. I want to try to catch the trend move, which means hold to the close. I think we've got some more. There it is. HTTC, hold to the close. In my view, and this is just my theoretical view of the marketplace, my experience of trading, the larger money is made by holding to the close. I don't want to catch intraday swings. Time's my ally. I want the trade to run. One of my really good traders, Brian Shad, was a Navy SEAL. And I was in San Diego at the time. Brian was a SEAL in training, deep diving SEAL. And Brian, whenever I talked to him, he'd always say, hold to the close, because he finally did enough trading that he busted out of the SEALs and became a full-time trader. But the only way you can catch a big trend move intraday, here's my point. To catch a big move intraday, you got to hold to the close. And we know most always these large trend days do close in an extreme. So that's how you trade it.
And Larry, so holding to the close, let's take a normal regular trading hours on the S&P or the Russell or the E-mini Dow. Are you finding a trade setup in the first half hour? And again, we can talk about this, or in the first half hour, in the first hour. Obviously, if we hold to the close, we have all day, and that gives us, like you said, more time to let it run. But are you just as excited about something that happens in the middle of the day as long as you're identifying as the same setups are occurring, if that makes sense.
Well, yeah, I think markets, called my freight train theory, markets start to move and they continue moving in that direction.
Okay.
So if you see a decent breakout in the middle of the day, well, that's really good because we know the traffic is going to pick up the end of your smile. So yeah, I like to see strength is usually followed by strength. Charlie D. Francesco, the largest bond trader in the history of the world, was a friend of mine. And I asked Charlie D one time, I said, Tom, Charlie, how do you work? Tom DeMark and I were with him. I said, how do you do this? He said, this is what I do. I walk around the pit, I'll trade 1,000 here, 1,000 there, just having fun. But I listen for the noise. And when it gets real noisy, I see what the trend has been. If the trend's down, I sell 10, 15,000 bonds. And I'll take a couple, 3 ticks profit on it, maybe 5 ticks. And if it's real noisy and I look at the trend's up, I buy. Because the idea is like a train is going down a track and the conductor pulls an emergency brake. The train doesn't come to a stop, it goes, stops. It can't stop that quick. You got that much noise, and Charlie's, because he was a floor trader, that much momentum going, you're going to have a little bit of follow through, enough that usually you're going to be able to get some type of an opportunity there.
Okay, interesting. I think you know, in prep for this, I was able to look at your slides, and I think you have a really interesting you know, example coming up. Let's just move to it. I think this is a great slide.
Well, I found a study that was done at 30 million trades and of commodity traders, and the traders were right more often than they were wrong. In other words, their accuracy was, they were more than 50% of the time they were correct, but they lost money. Well, let's look at our next slide. I think that might show why. Yeah, and this was really interesting. On a 12-month sample period, half of all the accounts that I had a 1-to-1 risk-reward ratio turned to net profit. Those under a 1-to-1, only 19% of them made money. So your per trade, how much your average profit per trade is huge. These guys, on balance, were right more often than they were wrong, but they lost money. They're looking at 30 million trades in the marketplace. The ones that made money, their average loss was at least equal or smaller than their average gain. So that's a critical number. People say, Larry, how accurate is your system? I don't care. I can show you a system that's 99% accurate. It loses money. 99 winning trades, one huge losing trade, it loses money. So accuracy is important. And it's not as critical as the average profit per trade. Your average winning trade needs to be at least equal to or greater than your average losing trade. That's the mathematical performance of the marketplace.
All right, and Larry, it seems so simple, right? You have more winning trades than not, or when I win more than not. But it's so important to focus on that risk ratio because of that, because it seems like it's such a fine-tuned instrument or a fine-tuned measure that, you know, it gets a little out of whack, and you could go from being, like you said, profitable to non-profitable, you know, successful to non-successful pretty quickly.
Yeah, real quickly. And I would follow up on that. Any book by Ralph Vince on money management, the must read. He's the brain behind all the money management schemes that have been developed. He's got the best of them. And clearly there's 3 or 4 important points. Accuracy is kind of important. It's not the only thing though, but that average win to average loss, it's huge. That's the number you got to focus on.
Great.
So this is how my trading philosophy of money management. I bet small. I'll have a small position, maybe 10 contracts in the S&P, and I'm hoping to catch a larger move that's going to last for maybe 3 days, 15, 20, 30 days. So I can catch a huge move potentially to the upside. And if I lose, I'm just going to lose that a relatively small amount versus a potential reward. That's the risk reward ratio we just talked about. That's how you do it. You never bet really big in this business. Okay, well, let's go back to indicators for a little bit. Most indicators are the same. You got to be careful of that. I want to make certain that the indicator serves a different purpose. So let's start looking at some indicators. I'll go to our, this is really important. I did this like, Tom, see that? I used to have one of those. When I started, really got involved in the markets, now it's 1965. And that's how we did math. There were no, some people, young kids can't understand. We didn't have calculators. You'd punch in the numbers and pull down that crank. and it would chug, 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 would print out the answer. Now, why that's important is because all of the indicators that everything is based on in this entire business are 10-day moving averages, 20-day moving averages, 100-day moving averages, 200-day moving averages. Why? Because those machines couldn't divide. They only added. So a 10-day moving average just moved the decimal point over 1. A 20-day moving average, you multiply by 2. You can do that on the machine. A 100-day average, well, it's 100 days, you move it over. That's all. So these indicators were all developed with this in the 1930s to about 1970, before we really had what we now know as calculators. So the time frames and the construction of the basic indicators of this entire business are because of this machine. We didn't have 31-day moving averages or 27.5-day. We didn't have any of that. And this tradition is carried through. We're still 10-day, 20-day. Occasionally you see a 14-day average. Why is that? Because some people back then thought that's half the lunar cycle, 28 days. Of course, there's 28 calendar days, not trading days. But indicators were based on those time frames, the time frame from the adding machine and from nothing else.
And Larry, you've just solved the riddle, because as somebody who's grown up with different platforms like NinjaTrader, you have access to any kind of time period. So you think, what is a 50 period? Well, that's 2.5 months. Why 2.5 months, right? Or 100 days. That's 5 months. Why is 5 months? This explains all of that. That's my aha moment from this show right here, Larry. You've solved the riddle. I love it.
Yeah, it's like, well, that's because it was easy to do it that way.
Right. No, that's great. I love it.
Letters before the internet, we used to get letters, and somebody emailed me or sent a letter one day, and I opened up the letter and said, "How many days are in a 10-day moving average?" The person wanted to know. And I wrote back and said, "Well, who's buried in Grant's tomb?" And then I got a letter back from him and said, "Why are you being smart with me?" Like, but we moved from that to now you can put in. Oh my gosh, it's so much easier to figure. I hired people that would come in after the markets closed and run on these adding machine tabulations and notebooks to get our indicators. We've come a long way, baby, from then.
Yeah, I mean, I heard stories. Most of your day, or a technical analyst back in the day, most of the day was spent accumulating and putting the data together. Right.
At the end of the day, if I was traveling, like I would be doing the next couple of days, I'd have to call my broker, write down open, high, low call volume in my notebook, keep track of that. I travel big notebooks to keep all the data, and I had people employed that did nothing but add numbers up at the end of the day. Yeah, it's changed a lot.
That's amazing. So let's jump to the next slide. I want to be mindful of time, and I do want to see some of the charts to explain what we were doing, but let's look at
these
this.
are things I think indicators can do. A little redundant. They can show cycles, measure accumulation, which is really important, show professional buying, show trend change. But yeah, I think we've got some charts. Let's go to the charts. We can bore people with just PowerPoints here.
Sure. Let me just, why don't you talk and I'll get the charts ready on my end.
So this is a cycle forecast that I did yesterday. This is the S&P on a 10-minute bar chart. The gold line at the bottom of the chart, that's simply my cycle forecast. It's an indicator based on cycles. I developed this 15 years ago, maybe. It's a combination of the 3 most active short-term cycles. And notice it goes way out into the right. It goes up 66 bars in the future. And it suggests what price should do. So when the market started to decline on the left side of the chart there, look what the indicator was doing. It's coming down and down and down, saying, yeah, we would expect the market to come down. Now Tom's going to pick up it. Remember, this is the forecast from yesterday, but it looked like a rally should start later in the day. So let's go to the 10-minute chart of that.
Okay, let me see. I did have a 10-minute chart.
And we're going to follow up on that from the, so it looked like the market started to bounce, come down into a low, and then start to rally. That's nice, because most indicators just say, well, they show the past. There it is. The chart you're looking at the bottom, now you can see exactly what happened. We had that bounce come up, and look where we are now. We have a projection that the market should now start to rally. So this gives a view of the future. Almost all indicators show what happened in the past. They don't show what happens in the future. And that's where cycles can be really helpful. Like, oh, right now, If I'm a short-term trader, I can see the market has been pretty much following the cyclical little forecast, and it looks like it's time to look for the market to now rally. So that
And that's a 10-minute chart on the E-mini right now.
That's a 10-minute chart. Yeah. Now, this is really interesting because I first did this on a daily chart of Apple, and then I went to intraday charts, and I found that it works there as well. It'll vary, though, to be clear about this. Sometimes it works better on a 15-minute bar chart, sometimes a 10-minute bar chart, but it doesn't take, click a button and you see, oh yeah, it's really in phase with 10-minute or 15-minute. Those tend to be the dominant ones. And it works pretty well on a daily chart as well to give me a pretty good idea of when in the future we can see markets rally and decline. So you see where we are right now. You can see where the forecast was, and market came down and see bounce in here. And put that on a daily chart. We may have that in the PowerPoint slides as well. Yeah, so
sorry about that. Let's see
problem.
what happened there. I think I grabbed it, put it on a different. Let me do this. Here we go.
So right now, we saw a low, and we saw that low, and the big up move came. Now it starts to suggest we should start to pull down until about the end of September. And that's when I would look for a cyclical bounce to the upside in the marketplace. Is it perfect? No. Does it give me a pretty good idea when to expect highs and lows in the market? Oh, yeah, it does. So, yeah, we can have a short-term bounce in here, but the next really significant move based on just this suggests, there you go, middle to the end of September. Typically, and the next time, I think we're going to do one more of these times, I'm going to have a trade for people in September. There's usually a sell-off at the end of September. And in our next presentation, I'm going to identify that for people.
Great, great. Now, we looked at the E-mini on these, but we can look at these on any market, right? I think we have crude.
You could put on crude oil, you can put on Bitcoin, you put it on, and again, there it is. That's crude oil. So you saw, yeah, we should have a rally. We should start to come down. We came down now. Look what started to happen. It suggests we should start to have a strong advance in the market. And lo and behold, that's what started to happen here. So it's a suggestion. You can't go based just on this clearly, but it says, I want to get ready here, get ready there. Then other things can confirm, say, yeah, it's time to pull the trigger for this trade.
And to be clear, this, as you mentioned, this is based on different cycles.
Yes.
Different cycle time periods. And so it's using historical data to suggest what might happen going forward.
Exactly. The time frames, I don't even recall what they are now. It's been so many years ago since I developed this, but there's probably like a 7-day, 20-day, and maybe a 30-day time frame. And then they're weighted because the nearby cycle is more important than say one from 30 days ago. So there's a little weighting that goes on into them, nothing fancy because I don't have a mathematical background. But it's just a combination of those cycles. And it's, for something I did 15, 20 years ago, it's really surprising how this has held up pretty well to say when we should start to see moves in the marketplace.
Well, and Larry, to that point, I mean, this is what's interesting about technical indicators is because we always think we're living in the next new normal, or this time it's different, right? How many times have you heard this times it's different? But this shows that, well, you know what, this might not be different. It's just like every other cycle, or, there's a suggestion there that cycles do repeat regardless of what's happening around us.
Well, the one consistent thing in market books, if you go back and read the books in the late 1890s, the early 1910s, 1940s, 1960s, even now, they'll say, well, the markets are really complex right now. Well, no, they're always the same. It's just our ability to deal with the markets. I think the markets are consistently erratic.
Right.
And they are driven by fundamentals. If you keep those two North Stars in mind as to what's happening in the marketplace and understanding how markets move, they simply become simpler to trade.
Sure. I want to take a look at wheat. You had a wheat chart up here. So, really interesting with wheat, with what, again, I'm going to go back to what's been going on, right? It's new, interesting times for us with what's going on in Eastern Europe and how that affects wheat. I think there's something going on in China that might affect wheat prices, but cycles don't care.
Well, yeah, and here's a real big point, though, you have to understand about cycles, is they don't predict the magnitude, they're only timing. So right now, the cycle forecast in wheat looks like a huge move to the upside, meaningless to me. It means we'll have a move to the upside. It does not tell us how big. Just like, and remember, we're looking now 66 days, 3 months into the future. The peak that we saw in June of this year was clearly identified by the cycle forecast. That the peak right below in the cycle forecast line, that was known 66 days prior to the market topping out. Just so we now see the future direction, anticipated future direction. But it didn't say how big the market move would come. The magnitude of the move comes from other things, from the fundamentals of the marketplace. So the fact we see a huge move, cyclical move, swing to the upside, doesn't mean the market will move that big. It's a rally. And then you have to use your own skills as a trader, your understanding of other indicators to see how significant this move might become. And
could you use this strength as a gauge of how sure you might be, or how you feel about that move? No. Okay.
No.
Great.
That's where cycle people get in trouble. See, a big 48-month, and the stock market is a huge 48-month cycle pattern. And sometimes we have big moves, sometimes we don't. The size of the cyclical swing, because it just measures top to bottom. And cycles really are about trend, about time, 28 days, 56 days, whatever the day period is. They say this is a zone. They don't predict this way. You got to be very careful. You don't predict magnitude.
Sure. Great. So I have a gold chart up. Now I'm switching to a different set of charts that have different indicators.
Great.
You mentioned, you have a whole suite of indicators, and if anybody, we'll talk about it at the end and how everybody can access this. And we're looking at a chart that has different indicators. Can you explain what's going on with this?
Sure. The green line is a measure of accumulation in the marketplace. And so we can see how price is holding up versus the black line versus accumulation. Notice right in the middle of the chart, about June, the market had a real strong day, closed right on its high. The next day it tanked. But that big up day, remember we talked about markets closing on the high is bearish, right? That's how they top out. And we see that the green line did not make new highs in there, which is suggesting there wasn't a follow through of volume. It was actually down. So, the market, there's been distribution in the market. Just like at the lows earlier, you saw the market had been coming down in there, but we started to see divergence between accumulation and price. And the original work for this was done by Woods and Magnolia, husband-wife team in San Francisco. My good friend Joe Granville popularized this with calling it on balance volume. But in the future market, I've used on balance volume for a long time. You know what? We're missing something. We're missing open interest. So I added in this formula a measurement of price accumulation, volume accumulation, and open interest accumulation. And this has done a pretty good job just at the lows that we saw this year, just a couple of months ago. The green line's not making a new low while price is. So the accumulation is coming to the marketplace. And we should be biased to the long side of the market. So that's helpful to see what's happening short-term accumulation, the combination of price, open interest, and volume all in one tool. The blue line at the bottom is the seasonal impact of gold. That's a seasonal pattern that gold is usually traveled, the way it's usually traded throughout the years. Big difference though, in my seasonal pattern, and I wrote the first book on seasonals and commodities way back in the 1970s. That was the foundation for all the seasonal work that you do now. And I did it wrong. I used the seasonal pattern, and everybody's repeated my error, the Williams error, is the seasonal pattern in all seasonal books right now, for now, look the same as they did, say, in 1920, because we get the seasonal pattern up through today and we'll push it back in time. But you didn't have today's data back then. So my true seasonal looks at seasonal price activity just up to today. And there's been a huge change, like, this saying, sell in May and go away, and the Dow Jones Industrial Average. Actually, that used to be the best time of the year to buy.
Oh, wow.
Buy in May until the Federal Reserve really got control of things about 1950. That was a good time to buy. So the problem, if you're doing research and trying to understand a market, if you use the traditional seasonal pattern that would push the pattern back in time, you're going to get some wrong conclusions. So my seasonal pattern looks and just notice that we should start to see a rally as we did the last year when we saw the accumulation divergence, right? And there's that time to rally. Good. We see short-term accumulation coming in and a seasonal low in the market. Makes sense to look for some type of trade to break out, trend line, whatever you're using as a trading opportunity.
Wow, that's interesting. That's great. And it's about your seasonality, the true seasonality, true seasonal study. When did you revise that? Was that recently, or was that?
That was about maybe 10 years ago.
Wow.
The 1970 book kicked off a plethora of a whole cottage industry of seasonal studies. And virtually everybody was doing the same thing. And one day I woke up and said, you know what? The seasonal patterns was different back then than it is now. What's going on here? And that's when I had the realization that I did it wrong and everybody followed my footsteps. I took everybody down the wrong path. And so this is what I now understand, is that we really need to have that seasonal pattern as to what was true then, not what's true now.
Right, right. Great. Larry, I hate to do this. We're over time and there's so much more to talk about. I know you can talk, there are so many more charts to look at and so many other ideas to look at and talk about. I want to thank you for your time, first of all. And, it's been a pleasure working with you to get to this point of having you on Traders Workshop. I do want to ask, where can people find you if they want to explore more? Because we do have new traders every day come into our shows. And the purpose of this Traders Workshop is to expose them to people who are experts. And where can they find you?
All they have to do is go to ireallytrade.com, because I do really trade. I don't publish anything anymore, no newsletter. I do an annual forecast report. And my indicators are available, of course, in Ninja. So the best place to find out about Larry, check me out, do a Google search, of course, but our website is ireallytrade.com.
Larry, thank you again. It's been a treat and it's been very informative. Again, I had my aha moment. I'm sure I'm going to be, Jim's going to say something and Mark's going to say something about that later. Why did I know? But it's really amazing. And thanks again for coming on and spending the time. And we look forward to having you back on next week. People, if you didn't know this, Larry's going to come back to Traders Workshop. We can get through more of his indicators and how he looks at the market, more charts. I think it'll be a great time. So again, Larry, thank you for coming on.
Well, thanks, Thomas. Always such an honor that people would listen to me. So I really appreciate that. And I will have some really interesting observations about September in the stock market next week. Until then, good luck and good trading.
Thanks, Larry.